My mission is simple, to help you protect your family and keep more of your money. I'm here to help level the playing field for families and those who seek the truth. There's always a new way to make money, but at the end of the day, it's your family's security and your legacy that matter. And I promise to help you protect what's really important to you. Legacy Money starts now.
Okay, welcome to Legacy Money. I'm Barry Page, your host, and I thank you for joining me today. This is the show that helps you live more, give more, and leave more. Today, we have a special program. I'm going to be answering your questions live, so you can ask your questions in the chat. I have some questions already that I receive pretty much on a regular basis, so I'll answer those, and you can just ask questions as they come to you, whether or not you're watching this live or listening, or maybe you're watching or listening to the recording. You can just leave your questions in the comment section, and I will get to them. But today, I just want to thank you for joining me. And if maybe you've been on the fence, or you've had some questions about really what we do, I'll be covering those. And now is the time to get your questions answered. So again, thank you for joining me. I want to remind you that there is a special financial tool that we use. We believe it is the center, the heart of your financial planning, your financial world, really, because it's the only financial product that can stand completely on its own, and that is participating whole life insurance from a mutual life insurance company. So before we get started, a few things. I really appreciate your subscribing to our channel, liking and following us on social media. That all helps with our rankings and to help me bring you more videos, informative videos, and just to help you with your quest to achieve the maximum efficiency you can with your financial plan. So also, there are specifically a couple things that I do want to mention. And I guess the first thing, you may have heard it there on the intro, but really my mission is just to serve you, to serve families. I want to help them learn the truth about money and how it really works, so they don't have to depend on the government, the banks. This is something that you can achieve financial independence on your own. And, regardless of where you are in life, this is for everyday Americans, citizens that pay taxes, that get up every day and work hard to take care of their family. So let's get into the questions. Again, I have a lot of questions, but really there's questions that you should be asking yourself as well. So whether or not you've had these questions or not, I get a lot of questions about life insurance and about infinite banking, which is really the core of what we teach. But let's get started. Here's the first question that I get pretty regular, and that is, how do I choose the right life insurance? And it really boils down to what you want. There's a lot of different flavors, a lot of different types of life insurance. There's obviously term and whole life are the most common ways that people look at them, but then there's many versions of each one of those. So I encourage you to just really do what you want once you speak with an advisor. They'll be able to help guide you, an agent, a licensed agent, with the right product, based on, what you want to accomplish. So there really is, the best life insurance is the life insurance that pays the claim when you're gone. Okay. And whether it's term or permanent, if you get term insurance, that's typically something that, maybe you're young, you're not earning an income yet, or you don't have the income that you want. So term is relatively inexpensive. You can get started for really very, very little. So start there. The most important thing about the term insurance is probably that you get it with a carrier that allows you to convert it to permanent insurance, whole life insurance, cash value insurance later on down the line without evidence of insurability, because that's really the big thing. Just this past couple months, I've had a couple clients that were declined. And, this happens, that's just part of it. Not everybody qualifies for insurance. So it is best to get it when you're young and healthy. But that being said, as long as you're in good health, you can get, insurance with some companies on up to age 75, age 85, even in some cases. Whole life insurance is something that you can use as a financial tool. And I'm going to dive into really some more questions about that. But hopefully that answers the questions about how do you choose the right life insurance. What are dividends? Okay, well, dividends are paid by mutual life insurance companies. They pay them to policy owners. Sometimes it's called participating. So if you participate with the ownership of a policy, dividends are paid. Now, they're not guaranteed, but most of the carriers that we work with have been around for well over 100 years, and they've been paying dividends each and every year for over 100 years. So that means through the Great Depression and through all the ups and downs, the recessions that we've had. So in a nutshell, dividends are paid from the surplus capital of the life insurance company. So, how much is the dividend? Okay. So, that varies. Every year, the companies will announce their dividends. And, dividends have been held, somewhat low. And I'll say somewhat, dividends have still been paying in the neighborhood of 5%. You can't confuse the dividend rate with an interest rate. And it's paid based on the paid up insurance in a policy, how long the policy's been in force. There's lots of factors that go into that. And dividends, since I've had policies, have gone anywhere between 5 and 8%, but they stay pretty constant in that area, 5 to 8%. It really just depends on the carrier and how they did that year. So what does overfunding mean? And why would you overfund a policy? Well, this is a common way that people describe paying extra into a policy. They do this, through usually a paid up additions rider, PUA is what it's called for short. And that's how you overfund a policy. So let's just say a policy has and I'm just commenting here. If let's just say you have a base policy premium, and I'm just going to pull out a number. It's $5,000 a year, depending on your age. Let's say you're young, and that $5,000, was buying $500,000 of death benefit. Well, with a life insurance policy, a whole life insurance policy, cash value policy, what happens is every year when that dividend is declared, this buys paid up additional insurance. As long as you have it set that way, you can determine what you want the dividend to do. But typically, that's what most people do. And so that gets you compounding. And so that compounds over time. And basically, you kind of have two policies there, the traditional or the original base policy, and then that paid up additional insurance. And that's how the death benefit grows every year. And that's how the cash value grows every year. So great question. So paid up additional insurance is how you overfund a policy. And why would you do that? Well, maybe you want to kind of kickstart a policy. That's really the backbone, let's just call it, of infinite banking. For people that want access to capital early, if you overfund the policy early, you will have access to the cash value earlier, because a traditional policy, a traditional whole life policy, won't pay a dividend the first year. And so there's typically no cash value there until about year 2 or 3. And then it starts growing, slowly. So the longer the policy's in force, the more the policy will grow. So that's how you overfund a policy. And that's why you might want to, if you wanted access to capital in that first year, you could do that. Now, that being said, I don't recommend taking policy loans or policy loans against a policy in the first year. You can certainly do it as long as there's cash value there, but typically I'd like to see someone capitalize a policy for 5 years, maybe longer, maybe shorter. It just depends on your goals and what you're trying to accomplish. The important thing is, if you take out a loan, it's very important to repay the loan, just like you would any other financial institution. The good thing about loans with an insurance carrier is that they are backed up by the death benefit. So it's really a good deal for everyone involved, and the policy owner, whoever takes the loan, can set the terms of the loan. All the insurance carrier requires is that the interest, which is billed in advance but doesn't come due until the next policy anniversary. And the policy anniversary, it's a good time to bring this up. That's when dividends are typically paid. They're declared, usually around the first of the year, but they're paid to the policy owner on the policy anniversary. So, great question. And here's another question. Why should I own life insurance as part of my financial plan, specifically for retirement? Okay. Well, again, I believe life insurance is the center of any financial plan. Without it, all else can fail. And it's really the only financial product that can stand entirely on its own. So if all else fails, the life insurance is there. You have access to capital via the cash value that's available, which again is all determined by how you fund your policy. I'll go ahead and mention every policy is different. And, so how you treat your policy is really what's going to make all of the difference. I'd encourage you to watch some of my videos on funding policies, how to build policies. I've got shorter videos, longer videos, but yeah, I'd be sure and check some of those out to help with that. All right. Okay. So the second part of that was, as part of the retirement part of the financial plan. So that's really how a lot of my clients plan on using their policies. Many will use it for banking early on, just depending on your desires. If you're going to make major capital purchases or you have emergencies, you can certainly access it for that. And, that's where the banking can come in. Maybe you have other investments that are, let's just call them pretty sure investments. I'm not talking about risking money in the stock market or on Bitcoin or some other uncertain asset, although people do that. But you can get yourself in trouble. All you have to do is just look at what's happened, in the crypto market, in the stock market. It's very volatile. Now, when you're talking about using it for retirement, that's a totally different thing, because when you get to retirement, let's just say you have a 401k or an IRA or some other type of retirement plan. The life insurance can be a buffer. It gives you a permission slip to spend the other assets without worry of running out of money. So, for instance, you may have heard of the 4% rule. And, if we work together, we'll get into all of this. But the 4% rule basically says that is the safe withdrawal rate. That is the safe amount that you can take from your retirement plan. So if you have life insurance as a buffer, as a storehouse for your wealth, and you're at retirement, then in the down years of the market, you can withdraw maybe more, or you can withdraw more than 4%, throughout that time. Whatever your asset may be, you don't have to worry about, that safe withdrawal rate so much, because you'll have something that you can pull money from during, any down year. So in other words, if you're taking money from an asset that has decreased in value, then you're in jeopardy of running out of money. And so really probably a better question to ask is to ask yourself, well, what kind of return do I need to get from my other retirement plan, right? And how long is that going to last me, right? Is that going to last me to mortality? So I can help you answer those questions specifically for you. So again, everybody's situation is a little different when it comes to that. All right, moving on. So what is the best company for infinite banking? IBC, the infinite banking concept. Well, that depends. It depends on your risk tolerance. It depends on your health. It depends on your age. I'm an independent agent, so I'm not really partial to any particular company. But as long as it's a mutual company, that's what we recommend for IBC. And particularly or specifically, a true mutual company. There's a lot of mutual holding companies, and just in the recent years, we've seen some of them maybe change their structure. But a company that's been around for a while, how about that? A company that's been around over 100 years, a company that has consistently paid dividends. So you can talk to your agent or talk to us if you want to schedule a time, and we can talk about that. But a mutual company is what the creator of the infinite banking concept recommended. And he recommended Nelson Nash was the creator, the author of the book, Becoming Your Own Banker. And so, what I often see is people, they haven't read this book. They tell me they want to do infinite banking and they've learned about it online, which is great. But if you have not read the book, it's really going to be hard for you to practice infinite banking in your life. So I definitely recommend you get a hold of that book, Becoming Your Own Banker, and you read the book. Don't just trust me. Don't just trust some other agent or advisor about that. And, specifically Nelson warned against universal life, which nowadays there's indexed universal life. And there's variable universal life, but what happens with those policies is the risk is shifted from the insurance carrier, and it puts the risk back on the policy owner. And so that's why Nelson didn't recommend those products. Now, I'm not saying they're not good products or you shouldn't use them, but that's really up to you. Personally, I like certainty and I like guarantees. And so you can get that with a participating whole life policy, dividend paying from a mutual insurance company. So hopefully that answers your question. I saw a video that recommended a 90-10 structure for a policy? Is that the best policy? Okay. Boy, I've been getting this question a lot recently. I never used to get it, but with the advent of YouTube and TikTok and all these other social media channels, people are making these videos, and I don't hear that much from infinite banking practitioners. I hear it from people that say they're doing infinite banking, but they don't. They're not a member of the Nelson Nash Institute, the Infinite Banking Practitioner Program. So, but you can certainly do that. You have to twist the policy, let's just say, a lot to do that, put term riders and things like that, so the policy does not mech. I just watched a video yesterday with, I guess, an agent recommending that, and he said he recommends it because that's what the banks do. Okay, well, that's what the banks do. Yes, the banks take your deposit, and if you put in 1,000, then they can loan out 9 more times that. So if you put in 1,000, they could loan out 9,000, right, to get the 10,000. So you might ask yourself, well, where does that $9,000 come from? How do they loan that money? And the question is, it's out of thin air because the money doesn't really exist. And if you want to learn more about that, I'd recommend you watch some of my videos. I cover the Federal Reserve meetings, and I talk a lot about that. But it's really over leveraging something. It's taking a good thing and it's really kind of twisting it a little too far. So I don't recommend that, especially for your first policy. If maybe you own a few policies, which most people do. If you want to practice infinite banking, Nelson said that it is to be a system of policies. So most people can't get everything they want in their first policy. My first policy was a term policy. It was with a mutual company, and I was able to convert that later, or parts of it. I still have part of the term actually from my very first policy. It expires this year, as a matter of fact. But I've converted the majority of that to permanent life insurance. And the good thing about that is you don't have to go through, the whole underwriting process again. If it's with the right company, you'll have convertibility options, and that allows you to do that. So, Nelson, if you look at the examples in the book, Becoming Your Own Banker, most of them are 60-40 type splits. And what does that mean? Okay, so let me kind of cover that. I talked about it a little bit earlier with a question about overfunding and PUA. So there's a base premium and there can be a PUA premium, right? And, so you can't buy all PUA. People say, well, why can't I just buy, all PUA? Well, because basically PUA is a single premium policy. And during the 80s, there were some rules passed by the government, TEFRA and DEFRA laws, and they created something called a MEC, a modified endowment contract. And basically that's when taxes were really high, from the 50s to the 80s, taxes were, income taxes I'm talking about, were very high. So people were putting all their money in life insurance. And they came up with this rule, because they wanted, that's also when mutual funds, qualified plans, IRAs, and the like were created. And so the government obviously wanted you to put money into their plans, right? Individual retirement accounts. So they created those laws, and basically it just says that you can't put all your money into a policy the first year. And they came up with this 7-year rule, the MEC ruling. It's changed a little bit over the years, and mortality rates have changed, CSO tables, things of that nature. So now, really, base policy with most companies, it's really only about 50-50, 50 to base, 50 to PUA that you can put without causing a MEC. Sometimes you can go up to 60%, PUA, but typically, just depending on your age, really, that's what it depends on, and how you fund it. But you'll have to put a term rider on that policy, and you can do that. But eventually, the term rider is either going to fall off or it's going to get real expensive and cause drag on the policies. And so what happens in these cases is, policies can become a MEC instead of doing it in those first 7 years. Policies can become a MEC 30 years down the road. I literally just ran an illustration for a grandparent yesterday that was going to MEC in the 88th year of the policy. So, you might ask, this is a child that had just been born, and it was a paid up policy at age 95. So, you just wonder, how could that even happen? Well, it's because of that ruling. And again, you can learn more about that in some other videos if you want to watch. But so is a 90-10 the best policy? Well, it depends. If it's your third or fourth policy, if you've got multiple policies and you're skilled at this, and you've been using banking already, then maybe, right? But again, there's caveats. There's good and bad. So if you structure a policy 50-50, 60-40, 40-60 in there, maybe even it depends. If it's a limited pay policy, you may not even be able to put a PUA rider on there. And with some companies, you can't. So if it's a 10 pay policy, or if it's a whole life traditional payable to age 100, that is going to determine how much you can put into that PUA rider. And so you'll have to determine that. And, you can, if you're looking at infinite banking, again, on page 38 of Nelson's book, Becoming Your Own Banker, there's a kind of a breakdown of how that works. So I'd recommend you read that, learn it. And, if you're talking to somebody about a 90-10 policy and you have not read Becoming Your Own Banker, that's probably a problem. I would not, or if that person is not on the Infinite Banking Nelson Nash Institute, infinitebanking.org website, I would be a little leery of that, especially on your first policy. Okay. How soon can I get to the money? I chuckle because, again, I've been getting that a lot in recent, let's just say in the past year. I rarely used to get that because people understood that, this is a long-term play. As a matter of fact, the first rule of IBC is think long-term, the infinite banking concept. Nelson laid out these rules, and the very first rule, think long-term. So if you're thinking about getting your money out after the first month or the first year, you're not really thinking long-term. And it also is just kind of a red flag to me that maybe you shouldn't even be doing this, because if you need to get access to the money, right away, chances are you don't have any surplus capital yourself. You don't have any savings, and so you should have 6 months of savings set aside before you even consider doing infinite banking. Okay, and once you get to that point, that's just for your own well-being, your own financial plan. Because you could become disabled, you could get laid off from work. Any number of things could happen. If you live where I do on the Mississippi Gulf Coast, you could have a hurricane. If you live in California, you could have, an earthquake. You could have a fire. Any number of things could happen to cause you to dip into your savings. So once you have 6 months of savings set aside, somewhat of a reservoir somewhere that you can access capital, then you can talk about infinite banking and maybe getting started. And the good thing about life insurance is you do have access to capital. And so depending on how you pay for your policy, how you fund it, if it's annual or if it's monthly, you'll have access to that capital. So yes, you can have access. To answer the question, if you pay annual and you have a PUA rider, or possibly a 10-pay policy, you can access the available cash value as early as the first month, 30 days. Okay. The insurance company wants to make sure the fund's cleared and you're not going to cancel, because you do have a 30-day free look. And, there's all kinds of laws, the Patriot Act, anti-money laundering, all types of compliance issues to deal with. But, I don't really recommend it, again, especially if this is your first time getting started, with life insurance. Okay. Here's a question. How much do I need in my retirement plan to retire? Well, that really depends on, your lifestyle. What does it take you to live? People, it used to be the magic number that was thrown around was $1 million. But, everybody's situation is different. What does it cost you to live today? That's really what you need to ask. If you were going to retire tomorrow, could you live on a lesser lifestyle than you're living on today? And, traditional financial planning, people think that when they retire, that it's going to take less money to live on during retirement. I've been speaking to a lot of people that are retiring here recently, and they're telling me that it's costing them more because of medical bills and taxes. Taxes, they come to fruition during retirement. So if you have a qualified plan, an IRA or 401k, just understand that all of that money, if you have $1 million in that plan, all of that money is not yours. And, so how much should you have? Well, it really just depends. But here's some nice, easy math. I mentioned earlier the 4% rule with safe withdrawal rate. So if that's the safe amount you can withdraw from that plan, think about that. So you got $1 million. Now it's your round number. What's 4% of that? Well, it's $40,000. Okay. And if you're living on $40,000 today, well, maybe that's enough. Okay. Maybe you have Social Security. That might be another couple $1,000 a month. But you got to understand that $40,000, and that's annual, you're going to pay taxes. So what's the net after taxes? What tax deductions are you going to have when you retire? And so along with that traditional financial plan, they tell you, have your house paid off, have your, excuse me, all your accounts paid off, and your children be grown. So you're probably not going to have a lot of tax deductions at that point. So, you just have to ask yourself, what's it going to take me to live? So, if you want to go through our process, then I can help you answer that question. How much is it going to take you to retire? But, everyone's situation's different. And again, you should be asking yourself that question well ahead of time. So that way, you know how much to contribute to your retirement plan, right? And by the way, you don't have to have a government retirement plan to retire. Okay, many wealthy people I know don't have qualified plans, and when I say a qualified plan, I'm talking about a government retirement plan. That's why it's qualified. It's qualified by the IRS. And so they're typically called things like IRAs, 401ks, 403bs, 457. You'd be amazed at how many people really don't even know what they have. They just tell me they're contributing at work, and it's a 401k. Most people know the name of that because it's, that's what we've been told. That's what we've been taught is the best way to save, for retirement. But there's many other ways to save. And really what you want to make sure is that you have accumulated enough savings or, in an investment to one day have that pay you an income. And I recommend having as many income streams as possible. So if you have a 401k, maybe you want something else. Maybe it's permanent life insurance that you can certainly use as an income stream. Maybe it's an annuity. Maybe it's Social Security. Maybe it's a business. Maybe you're self-employed and you don't have access to a 401k. Now, certainly you can have an IRA, a SEP, they call it. Simples, other types of qualified plans are available to self-employed people. But, again, I recommend having as many income streams as possible. So, that may mean starting a business, a side hustle. I hear a lot these days. There's many small businesses that can help you. And the good thing about having, a small business is that you can get some tax deductions, right? And this might help offset some of the taxes that you have to pay. So hopefully that answers your question. But really, you just want to know when you get to that point in life, whether it's 65, 67, 70, people tell me all the time when they're younger, they want to retire at 50 or 40 and I have to chuckle because I said the same thing. When I was younger, when I was in my 20s, and I was actually making some pretty good income in my early years while I was still in college. And so I thought I was going to retire at 40. I was misinformed and had to learn some hard lessons. I had to lose some money, which I've lost a lot of money along the way in the stock market, in real estate. I've also made a lot of money in those areas as well. But easy come, easy go when you're young. When you're older, it's not so much easy go. It's once you've lost money, you don't want to experience that. And that's the last thing that you want to happen with your retirement plan. If you have, one of those qualified plans, or you have mutual funds or whatever you may have, stocks, and you lose money during retirement, or the market goes down, the market crashes like it has before, and many people think it will again here before long. You don't want to be drawing money from that account. And so the question is, do you have time for it to recover? And, let me just make some round numbers for you. And this is pretty simple to understand, I think. If you got $1 million and you retired, today, and, you're going to start taking money in the first year, and your money's still in that mutual fund or still in the stock market, and the market went down 30, 40, 50%, like it did in 2008, 2009, and you're retired. How's that going to affect your retirement plan, right? How much do you have to make the next year to get back to where you were, right? And obviously the market's been going up for the last few years, and that's great. Hopefully you've been able to enjoy some of those gains, but you don't realize the gains until you take a distribution, until you take out that money, right? So, just because the market's gone up and maybe your million grew to 2 million, and I'll use that as an example. Let's say your million grew to 2 million, and then the market goes down. I'll use a round number, 50%. So you're back to $1 million. Okay. Now, how much do you have to earn next year to get back just to your 2 million? Think about that a minute. So a lot of people say, well, if I lost 50, I just take 50. Well, no, 50% of $1 million is 500,000. So now you're only back to 1.5 million. And if you're taking money out, okay, then, you could run out of money. So it actually would take 100% return just the next year to get back. Now, over time, again, Maybe the market's going to grow again, and it usually does grow pretty rapidly, after a crash. But again, if you're withdrawing money, if you're taking distributions, you might want to look at some other options. And so that's where, life insurance can supplement a retirement plan. You could, the year that it went down, instead of withdrawing money from the mutual fund or stocks or retirement plan, you could withdraw money, take a distribution, take a loan, from a permanent life insurance contract. And so that's a great question. All right. How can I finance with life insurance and be my own bank? That's a great question. Again, I recommend reading this book because, Nelson Nash, the author, wrote this book specifically for the public, for the average family. And you can learn a lot more about that. But, to answer the question, how can I finance the life insurance? Well, once a policy is capitalized, and again, I recommend, 5 years. That's the examples that Nelson uses in his book. The longer, the better, though, right? So you have access to that available cash value, which typically does not show up until after the first year. And it's not going to be much the first year. It really just depends on how you fund the policy and how you treat your policy, right? But policy loans are loans against the policy. It's collateral. The policy, the death benefit, the cash value is used as collateral. So the loan is actually from the life insurance company, and they will loan you the money without any Mickey Mouse paperwork, Nelson used to call it, right? You don't have to, maybe one simple form, if even that. I know now when I take policies, loans against my policies, it's as simple as going online and clicking a few buttons, and the money arrives in my account. And usually, 3 to 5 days. In some cases, I've had the money there the next day. But it really just depends on, processing and all of that. And if you've done it before, once you've done it, it becomes a lot easier. And, the company trusts the bank account or wherever, you have it. You might just have a check delivered to your home. They will deliver the check in the mail. That might take, 5 business days, 2 weeks to get that in the mail if you're not in a hurry. But obviously the fastest way is through, bank transfer, ACH. And, you might count on 3 to 5 business days for that to happen. And so that's how you would do it. It's really important, if you take a loan, that you consider repaying the loan. And so your agent will work with you on that. But I highly recommend you set up an amortization schedule, and you repay the loan just like you would any other financial institution, just like you would a bank if you borrowed money. But the difference is they set those terms, and in this case, you can set the terms. All the insurance company really requires is that the interest is paid, and you can even pay the interest, through another policy loan. But that's really another question, and I don't want to get too deep into that. It really just, depends on you. So every situation is different. So can life insurance be used for retirement? All right, I've somewhat answered that already. And again, it's just a distribution. There's many ways to do it. You can surrender. You can take a loan. You can take dividends, right? If you're at retirement, chances are you've had your policy for a while. And so typically it takes about 10 years for a policy to really get completely on its feet. So you could take the dividends then if you wanted. And, but understand that if you do that, you're kind of stunting the growth. And so that's why, maybe, loans might be the best option, because you can always repay a loan if you want, if you get a windfall, or maybe you want to take out a large chunk, from your retirement plan, put it into a tax-free environment. And that's another thing that I'll just go ahead and cover. I mentioned earlier that your qualified plan is going to be taxable because you just deferred taxes, you postponed taxes. So, maybe you don't want to continue to pay taxes for the rest of your life. And that's, if you're using that 4% rule, if you leave the money in the plan, then, you're kind of setting yourself up to pay taxes for life. So you might want to consider moving that money to another asset. And, there's many ways to do that. So talk to your advisor, talk to your agent about that. All right. Last question that I have here. And, if you have any more, again, maybe you're watching this as a recording, you can just leave your questions in the comments and I'll be glad to answer. Actually, there are a couple more here. So here's one that I used to get a lot. I still get it sometimes, but nowadays, I don't get it as much because it's I guess the word's getting out about infinite banking. Unfortunately, like I said, I think sometimes it gets out the wrong way. But the question is, why haven't I heard about this before? Well, I don't know. Maybe you hadn't talked to the right people. And here's the first thing. So life insurance is a private contract. So most people that own it, they're not out telling everybody that they own life insurance, right? But and then the people that you hear that maybe complain about life insurance, maybe they didn't have the right agent, the right company, maybe they didn't set it up correctly, maybe they bought some of that universal life insurance that's put a sour taste in their mouth because they find out that as they get older, they have to put more money into the policy just to maintain the policy. So, why haven't you heard about it? Maybe, again, you just haven't talked to the right people. And, most advisors aren't going to recommend it because, they'd rather manage your money. And that's fine. If you like somebody managing your money, that's great. But if you talk to, an agent that works with a mutual carrier, they can explain it. And, I had somebody just earlier today, I had a meeting that, this person had an agent, and this agent had worked with their parent, and they had found the book, Becoming Your Own Banker, and they had read the book. And so they asked the agent, if they could set up a policy like this. It was a mutual company. Not every mutual company, let's just say, promotes infinite banking. So you'll want to work with an agent if you want to do infinite banking that way. But as far as just life insurance in general, I guess it's just, my guest last week, he wrote a book about it. He called it The Missing Piece. So David Saucer, you might check out his book on Amazon, The Missing Piece. I don't really know. There's a lot of people that beat up life insurance, and I would just say if you find somebody that has owned life insurance for more than 10 years, you're probably not going to hear any complaints. People that maybe lapse their policy in the early years, maybe they set it up wrong. And when I say set it up wrong, they kind of set the bar too high. They put too much the first year, and then they couldn't fund it the second year. But, after a policy is about 2 or 3 years old, if it is a dividend paying whole life contract, it'll pretty much take care of itself. I've had families, couples that have gotten divorced, and, their policies were only about 2 or 3 years old. And, of course, at that point, they didn't want to pay their premiums, for the other person. And, those policies, held up until they were able to, you know, um, take ownership of the policies again, or they still had the ownership, but until they got to a place where they wanted to fund the policies again. And so, really, again, the life insurance contracts, they have guarantees. So it's really hard to mess it up. Um, but you can. And so that's why it's good to work with an agent that understands it. So, that's important. And, a question I get asked is, when is the best time to start? And I would just say as soon as you can, right? And so one thing that happens a lot when I run into people that are maybe older, is they want to get the policy on their children, right? And you can certainly do that, but you have to understand, if something happens to you, um, who's going to pay the premiums or fund the policy? So it's always better to start with yourself. And most of the carriers are not going to let um, you have a policy on a child unless you have substantial assets or life insurance yourself, right? And maybe you've been declined or something. I don't know why else, but if that's the case, then you could, own a policy on the child. If you've got more than one child, you've got children, then they're going to usually want you to fund policies, equal, for those children, just so there's no hanky panky, let's call it. All right, so that's about it. I do just want to kind of wrap it up with, the title of this program, Legacy Money. Um, I've talked a lot here with these questions about life insurance and, financial plans, retirement plans, and infinite banking. But really, what do you want your legacy to be? How do you want to be remembered? How do you want your children, your grandchildren, to remember you? Um, there's many ways to look at that, but most people tell me, most parents, that they want to, leave a better life for their children. And so people do a lot of things. They create trust. Um, they buy property. They leave land. They even leave their retirement plans sometimes to their children. But there's ramifications to all of this. And, specifically, let's talk about taxes. Taxes, unfortunately, probate, all of these things can come into play. So life insurance can allow you to create a legacy literally from day one, right? Once a policy is in force, it has a guaranteed death benefit. And, that will be paid to the beneficiary income tax free. And in most cases, estate tax free, unless you are extremely wealthy and, you're over that estate tax limit, 13 million, I believe it is now, per individual. So, and even then, life insurance is a tool that can help you with that. It can help you create a legacy literally from day one. So I would encourage you, if you have any of those things in your mind, to go ahead and get started. Take a look at your financial plan. Sit down with an advisor, an agent, and a representative that can help you. And if you need our help, you want to talk to us, usually there's a link in my videos, so you can learn more by subscribing to our channel. And if you like this video, please give me a thumbs up. And if you have any questions, you can leave them in this comment of this video, or you can email us. You can call our office. But thank you for your time today. And I'll see you in the next video. Usually I'm live on Wednesdays. That's not every Wednesday, but if you're on our mailing list, you'll be notified about that. So I appreciate you joining me. And again, have a great day. I'll see you next time. And keep learning, keep growing. Read. If you want to do infinite banking, again, read this book. And Nelson has other books that he recommends you read as well. So we'll talk soon. Thank you.